Senator Daines, thank you so much for having me. Thank you for that kind introduction. Joe, you drove up here by car. You all probably think that I brought the train up here. I didn't. So the forum's about technology. I'm going to talk a little bit about technology, but I'm also going to talk about an overview of the railroad. And I'll just start with the two greatest technological things I've seen in my career as CEO and now chairman of BNSF, which has been over 15 years, is what's happening in domestic energy. And I would tell you that the first 10 years of leadership at BNSF, I witnessed our customers all leaving the United States in terms of going offshore of production. In the last 5 years, I've seen just the reverse. And it's a story that most people in our country don't understand what's going on, but it really is driven by the domestic energy blessing that we have been given. And if you go down to the port of Brownsville all the way to the port of Mobile, there's probably $150 billion worth of investments that's being made just because of the advent of the overabundance of low natural gas. We see it in the Midwest, where we were literally importing ammonia, and now we're producing ammonia, and we're now exporting it. And so the conference that you all are focusing on is vitally important, and I hope I can put a couple perspectives in terms of how we see it on the railroad as well. So the conversation that I'm going to have today is, quite frankly, not for the faint of heart. There's some really hard issues that we see in terms of what's going on in the railroad, and I want to cover these off. And some of them, quite frankly, are structural changes that we see, and some of it's due to, quite frankly, some of what's going on with the permitting issues that's out there of the keep it in the ground type of mentality. And quite frankly, some of these things are changes that I haven't seen in my entire career. I'm also going to talk about some of the headwinds that are facing the growth for both the railroad and Montana, and why I think the call that Senator Daines made of we just can't stand by, because regulation will stand in the way of Montana's energy growth. That is just a true fact. And then finally, I'm going to look forward a little bit and talk about where some of the opportunities are for BNSF and the state of Montana. So here first, let's start with the commercial of the railroad. This is what it's all about. We've got a 140,000-mile rail network in this country. It moves about 40% of all the ton miles that move on the surface of our country. We're certainly more efficient than most other modes, and quite frankly, shippers pay less for shipping rail. A double-stack train now moves almost 250 long-haul trucks. So when you see one of those big trains, you see the technology that we've been able to improve of being able to handle longer trains, distributed locomotives, things like that. And listen to this fuel efficiency number. We move a single ton of freight 500 miles, so 1 ton of freight, 500 miles on 1 gallon of diesel. And we think that that's true fuel efficiency. And when we do that, we're able to reduce greenhouse gas emissions by almost 75%. BNSF specifically, we operate 32,000 miles. We operate in 28 states, 3 Canadian provinces. We operate about 1,200 trains a day, and we employ about 42,000 people. Last year, we shipped the most units of any railroad in the United States, more than 10.2 million units, and that includes shipping containers, carloads, tank cars, all those various things. Well, I know most of you all here are very interested in the energy sector, and so BNSF is very tied to the energy sector, and not only what we burn, but what we haul. Energy products make up about 30% of all of our freight portfolio, including coal, crude oil, LPG, and ethanol. And not reflected in the chart, we also move windmill turbines. Last year, we moved almost 2,400 blades in a single year. Well, certainly Montana is an integral part of our BNSF operations. It's right in the middle of our network, as everybody knows. We call it the Great Northern Corridor, our route from Seattle to Chicago that links Montana coal and ag to the Pacific Coast and the Midwest and beyond. BNSF employs about 2,500 Montana employees. We move the goods that Montana produces and those that it consumes, which is approximately 2 million loads of freight in the state annually. We own about 2,500 route miles of rail in Montana and operate 9 rail yards, serve more than 20 grain shuttle stations, and a number of coal mines and other industries. Let me give a good example of Montana and BNSF's energy transportation partnership. Calumet Refinery in Great Falls, they made a recent $400 million expansion and increased their refinery capacity from 10,000 barrels a day to 25,000 barrels a day. Their expansion has and tripled the rail transportation needs of that facility. They depend on pipeline and rail for their feedstocks, and about 2/3 of the diesel and the asphalt they produce is delivered by rail to regional markets. Rail volumes are a really good indicator of how the economy is performing. There truly is a close correlation between the health of the railroad industry and the overall economy, specifically the industrial economy. This chart shows the freight rail volumes between 2006 and 2015, which I think tells the story of the U.S. economy. It shows peak volumes of 2006, then the troughs of the Great Recessions of 2008, 2009. In 2006, North American rail volumes had their highest week with 923,000 units. The lines for capacity and demand were beginning to cross for railroads, the highways, and the ports. I told our team during those years, the 2005 and 2006 peak years, that we would either need to build out our capacity to handle the demand or shrink our way into equilibrium. Well, the economy made the choice for us. The recession created a large temporary surplus of capacity on both the highways and the railroads. Freight railroads lost about 20% of their overall volumes. Consistent growth in rail volumes didn't begin again until 2010. Then as the economy limped its way out of the recession, rail volumes actually grew at about double the 2.2% rate of the economic growth from 2010 to 2014. The industry struggled with handling the volume growth during the 2013 and 2014 timeframe. The number of the units on the railroad never quite got back to that peak. The industry was about 98% back to the peak that we were in 2014. But we exceeded our peak in gross ton miles, which reflected a shift in the traffic mix of from the 2006 peak to heavier commodities like coal, crude oil, and grain. Throughout this period, the freight rail industry, and specifically BNSF, participated in a virtuous cycle of increased volume and increased investment as the industry climbed out of the freight rail recession. Since 2000, BNSF's invested, Since 2000, BNSF's invested more than $53 billion on our network, and BNSF's had an all-time record capital programs in 2014 and 2015, totaling $11 billion. We added more than 200 miles of double track, 875 miles of centralized traffic control, 18 new sidings, and more than 25 extended sidings. These investments gave us expanded capacity for improved service. Our performance was strong in 2015, and we're carrying that momentum into 2016. Our infrastructure, quite frankly, is in the best shape we've ever been in to meet the customer needs and to operate safely. And while we're in position for growth, our business model is based on growth, and we're committed to that growing for our customers. Unfortunately, as we turn the corner on 2015, volumes have not been what we expected or planned for. Overall, 2015 rail industry volumes were down about 3% versus 2014. The second half of 2015 saw volume levels descend further. The downward trend has continued into the first half of 2016, and we don't see a lot of growth in the near-term to mid-term outlook. North American industry non-intermodal carloads have declined more than 5% in 45 of the last 48 weeks on a year-over-year basis. The current period of sustained weakness has not occurred since the Great Recession of 2009. Let's talk a little bit more about what we're seeing in the economy right now. The industry tracks 22 different business segments, and this chart shows the percentage change from February 2015 to February 2016. 13 of the 22 segments are declining on flat. That was the 13th month in a row that declining commodity segments outnumbered growing segments in the rail sector. In the fourth quarter of 2014, there were 19 growing segments, and 3 were flat or declining. You can see the economy really has turned to the negative. The U.S. economy is running on 2 divergent tracks at the same time. a contracting industrial sector, and expanding but slowing service sector. I describe it that we are in an energy depression, an industrial recession, and consumer is doing just okay. On the slow track, the industrial sector continues to contract. The weakness is driven by multiple related headwinds tied to lower commodity prices, the strong dollar, and slowing growth in China. The supply chain is carrying the largest inventory surplus in 5 years. On the faster, but not so fast track, is the consumer sector, which represents about 70% of the GDP of the country, and it's what's managed to keep the economy afloat. Low commodity prices and the strong dollar can actually be helpful on the consumer side, although the benefits come much more slowly than the negative impacts on the energy and industrial side. Here's what's been going on at BNSF. Overall volumes were essentially flat in 2015 versus 2014. However, this is a bit deceptive because there was definitely more freight available in 2014 that could have been moved if not for our service challenges. Having said that, we still moved a lot of freight last year in 2015. BNSF hit its post-recession weekly peak as service recovered, moving almost 215,000 units in a single week, only 4,000 units below our pre-recessionary levels. Not only was the railroad able to handle more than 200,000 units in a week, we did it 25 times last year. Looking at each of the business units, we can better understand current market conditions, starting with our ag business. Ag volumes on BNSF in 2015 increased year over year 8%, primarily due to stronger domestic grain demand and milo exports. In 2016, ag products on BNSF were up 3.4% year to date, driven by record soybean exports through the Pacific Northwest ports. There are significant headwinds for agricultural exports, global competition, low commodity prices, and the strong US dollar, which has grown more than 20% since July 2014. Also, global supplies are high, prices are down, and farmers are building storage. Grain supplies will eventually move, but who knows when. Shifting gears to intermodal, our consumer products move on truck and rail and sometimes from a ship. BNSF intermodal volumes increased slightly in 2015, about 0.5%. We were 90% back to the peak 2006 volumes. In 2015, international volumes were down almost 2% as shippers diverted freight from the U.S. West Coast ports in response to ILW labor negotiations. A labor contract was finally reached in 2015 in February. Pent-up demand created the disruption, began to clear in March. It's hard to tell exactly how much we know, but a certain percent of that freight didn't come back. On a brighter note, BNSF domestic volumes converted truck to rail were up 2.4% year over year, and there's still potential growth due to multiple challenges facing the trucking industry. Although it's a bit tepid right now due to slowing consumer spending levels. Looking longer term, taking truck miles off the road is still our best and brightest proposition at BNSF, and I believe our industry is set to do that. Turning now to industrial products, BNSF volumes in this segment were down just about 6% 2015 versus 2014. Year to date in 2016, industrial products are down about 10%, due mainly to business related to crude oil, drilling, and production. As a result of lower crude oil prices, crude volumes decreased 10% last year. In 2014, we were averaging about 750,000 barrels of crude oil per day, and that volume declined to about 620,000 barrels per day in 2015. This trend has continued to worsen through 2016 to where we're now down about 360,000 barrels a day. Not surprising, other input commodities such as minerals and frac sand were also down in 2015, about 20%. While we don't see this as a short-term trend, oil prices likely won't recover for some time. The strength in the US dollar, as I mentioned earlier, as well as cheaper imported steel, has also impacted steel products and drove our 2015 steel volumes down over 22% last year. The soft steel markets had a negative impact on the upstream commodity markets for taconite. This negative trend continues in 2016 as we see steel and taconite both down almost 20%. Well, there's definitely a few bright spots, such as plastics. 2015 volumes were up 20%. The shale revolution and low natural gas prices have changed the dynamics of the petrochemical market, as I started off with, and I'll talk a little bit about that here in a minute. Aggregate volumes also rose in 2015, about 6% year over year, as infrastructure demands in places like Texas drove increase in highway construction while it remained strong into 2016. We also ship a lot of Montana lumber materials for construction across the state and the United States. The housing market is showing signs of life, and shipments of lumber and panel products have shown slow but steady growth so far in 2016, about 5% year over year. In 2015, coal volumes on BNSF were essentially flat, which probably surprises most of you, and it isn't exactly what it all seems. Let me explain. At the beginning of 2015, we saw strong consumer demand focused on rebuilding inventories due to the underperformance that we had in 2014. Continued service improvements and mild winters have drove stockpiles to historic highs, 105 days at the end of December and through the end of last month. For decades, coal has been the primary energy source for generating electricity in the United States. However, low natural gas prices have driven a fundamental shift in electricity generation. The EIA is now forecasting that 2016 will be the first year that natural gas-fired electricity generation will exceed coal generation in the United States on an annual basis. In 2013, coal was still about 40% of all the tonnage and nearly 20% of the rail volume for the U.S. Class I railroads, and coal accounted for approximately 1 in 5 railroad jobs. This year, coal in the United States has decreased more than 25% year over year as mild winter weather continued to significantly reduce electricity demand, and natural gas prices reached new lows, causing electric utilities to maintain switching from coal to natural gas. This downturn, while it's been happening for a while, the real story, though, is the weakness in the coal business was masked by the offsetting growth in crude by rail. Now that oil prices are low, the real impact of declining coal is being felt. Long-term prospects continue to show less and less coal demand between market changes and the regulatory vice that the EPA has constructed to kill the future of coal, and we're truly in the middle of a structural change in these coal markets. At the end of the day, coal is declining at a very steep rate, and that means a significant shift in what our freight railroads will move. Our infrastructure will also have to support these new movements. Unfortunately, we find ourselves in a very challenging freight environment. Economic cycles are coming more quickly with greater variability. Economic cycles are, in fact, a way of life and will come and go. So we must position ourselves to capture growth as opportunities present themselves. There's headwinds against our ability to do that. Over the past few years, there's been a shift in public conversation about rail. We're increasingly facing an opposition focused on particular commodities, coupled with communities that no longer want to connect our transportation supply chain to something that benefits them or their regional economy. The permitting process has become a weapon to stall or to stop new projects. You only have to look as far as the proposed coal export facilities to see this in living color. Permitting these facilities has been underway for almost a decade, and little to no progress has been made. Yet this is a potential market opportunity to expand coal exports to Asia, and for Montana that has a competitive advantage by accessing the Asian market as a marginal supplier. No U.S. West Coast port currently exports Powder River Basin coal. 2 large-scale export terminals are in the permitting process in Washington State, but the political environment and the broken permitting process have been leveraged by those who oppose to fossil fuels to make the West Coast ground zero in this climate debate. That certainly hinders our railroad's ability to grow, but there's a much larger point here as well. As you sit here in Montana and look to your opportunities for future economic growth, it doesn't matter if you have the best coal reserves in the Powder River Basin or the best shale formation in eastern Montana or even the best grain that countries around the world want to import. If there's nowhere for your commodities to go, no destination terminals to take that commodity for export to global markets, those commodities have no value. Another state and those opposed to your product are preventing your ability to grow as well. Coal export is but one example of a much larger problem hindering our ability to build the necessary infrastructure to be competitive. We all cannot afford to sit on the sidelines and think that that's not our problem, because it's not only the coal that they don't like. So where does it stop? We've seen it unfold in coal and crude. But what's next? Genetically modified grain? It's not a stretch of the imagination to see this continuing to play out. We're actually not seeking any special treatment in permitting or looking to short-circuit the environmental process review. What we're asking for is a fair, consistent, and timely process. Without it, who will possibly take the risk and invest millions of dollars required to build new facilities to bring Montana products to the rest of the world? You only have to look to your neighbors to the north to see an example of a private sector and a government getting it right. Canada's Pacific, excuse me, that's a Freudian slip, trust me. Canada's Pacific Gateway strategy, where collaboration between the public and the private sector has the singular goal of enhancing transportation mobility to improving British Columbia's position as the premier entry point connecting Asia and their North American markets. Essentially, it's really one large public-private partnership with a national and provincial government, along with stakeholders in the supply chains like ports and railroads, have all focused resources towards the goal. It's a true national freight strategy. They've spent billions of dollars over the past decade, and Port Metro Vancouver's volumes have risen every year. It's really a wake-up call to us all across the northern tier of our United States on what we need to remain competitive. So what does all this mean for the future? I want to frame the answer in three buckets. First, public policy needs to support, not hinder, infrastructure development. Second, for a robust transportation network, there needs to be adequate rail investment in all modes of transportation, and BNSF is investing in the rail network serving Montana. And finally, from a freight volume outlook perspective, what's the next growth potential what it's actually going to look like? Starting with public policy, specifically a national freight policy. I've probably already said enough about policy not getting in the way. I'm pleased to report, though, there was significant progress in the FAST Act that was recently passed. Don't get me started on the Highway Trust Fund. Highway users need to pay more. But if Congress did make substantial progress on the number of other important transportation policy issues in the last highway bill, thanks to leaders like Senator Daines and Senator Tester and Congressman Zinke. There's now a program in place to help fund those big freight projects that no one entity would fund alone. It's essential to a competitive supply chain. Projects that are often taken for granted and operate unseen in the background, but are hugely important to improving the freight efficiency. Things like multimodal connections to ports, fluidity of truck traffic around intermodal centers, mitigation of community impacts from increasing trade traffic, and reasonable permitting requirements for important transportation facilities. That's really what Canada is doing well. They see the positive impact to their economy, jobs, and the quality of life due to trade. What they're not doing is trying to block the growth of certain regions of the country based on whether or not they like the economy, the commodity. Our Montana investments have been significant, have expanded our capacity in the state. We are forever a better railroad, especially in Montana. Between 2013 and 2015, BNSF invested more than $500 million in the state of Montana, $187 million in 2015 alone. These investments have been an important part of our transformation of the Northern Corridor, which is almost the same fundamental level as our almost completely double-tracked Southern Transcon. Between 2013 and 2015, our total investment in the Northern Tier has been $3.5 billion. It's an unprecedented expansion of freight rail capacity that includes more than 140 miles of double-track railroad. These investments will help ensure that the competitiveness of the supply chain for all Montana producers and products that need to move, including that those have in the competitive international environments. In 2016, our maintenance program in Montana is earmarked at $180 million, includes more than 950 miles of track surfacing or undercutting, replacement of about 120 miles of rail, and close to 300,000 railroad ties. Things like that are critical to the efficiency and also to safety. The third bucket is really the hardest, predicting volumes. While we have this freight transportation infrastructure in place, what are we going to haul from Montana to the West Coast for export or anywhere else? I don't know the what or the when, but I know that there will be growth, a new opportunity. Earlier this month, the U.S. Department of Transportation released the 30-year freight rail projections. They're showing that the freight tons moving on our nation's transportation network will grow 40% over the next 3 decades. Our supply chain exists to support whatever needs to move from point A to point B, and sometimes that picture looks different from day to day or year to year. Well, what does this look like for Montana? Let me start with a couple of recent examples to get you thinking about the kind of opportunities that might be waiting around the corner. No one would have predicted the role of rail in the resurgence of oil. From the first unit train departing the EOG facility in North Dakota on New Year's Eve in 2009 to the peak in 2014, where we were averaging about 750,000 barrels a day. A second, more recent example is the performance of the petrochemical resurgence that I mentioned earlier. The shale revolution and low natural gas prices have definitely changed the petrochemical market. In 2009, volumes in this market were stagnant. Now, with these huge capital expansions in the Gulf, we're seeing volumes increase about 30% a year. A lot of that is earmarked for export. We're also transporting the resin by hopper cars from the Gulf to packaging facilities in Texas, where there's large supplies of empty ocean containers going for export. The resin is packaged and loaded into 40-foot containers for export, for these containers are moved by rail to the east or the west coast ports, destined for export markets in Asia and Europe. The reason I share both of these examples, I want to leave thinking about the next opportunity. We don't know what that opportunity will be, but we have to be positioned for it, and at the least, to be able to capitalize on it. We're hopefully encouraged, develop, and grow it. Montana's advantages are many: abundant natural resources, a highly trained workforce, and your position on what we call the Great Northern Corridor. Montana's positioning on the Great Northern Corridor gives you access to markets across the globe, provided efforts to prevent that access are unsuccessful. The domestic energy revolution has put Montana and the U.S. in the position to be a low-cost energy market for the foreseeable future. One of the secrets of our success has always been low cost of energy. This gives you in our country the opportunity to build our manufacturing base, providing good jobs for this country. Whether it's value-added agricultural processing, petroleum refining, or wood products, Montana will be in a position to grow its manufacturing industry if you leverage these resources. With that, I want to again thank Senator Daines, and if there's still a few minutes, I'd be more than happy to take any questions. Thank you very much. Yeah, so the question is on safety and some of the technologies that have been implemented to transport oil. So when the oil revolution happened, I mean, it came very quickly. We don't own the tank cars that are transported. I think all the producers would have thought that if there were any issues in the transportation of this product, it would have had a lower volatility level. We found that out not to be the case. We worked with the Department of Transportation as well as PHMSA to come up with new tank car standards, as well as we took some voluntary actions on the railroads, such as speed mitigations, improving more technology, what we call on-track rail detection to look for defects, things like that. All that is now behind us. We have new tank cars that are in service. There's also the question of whether or not the producers will eventually want to extract more of the NGLs in the oil to reduce the volatility, but our focus has really been making sure we have the right tank car to be able to handle it, put the technology on the railroad that if there ever is an accident, which is very rare in our business, that we would have very low impact to the communities in which we serve. Anybody else? Yes? I'm sorry, what is? So double track rail, it's just simply that the majority of the Great Northern Corridor between Seattle and Chicago, the Great Northern part of the railroad, was basically a single track railroad with sidings. And so when you hear about congestion or things like that, whether it's on Amtrak or the freight rail, it's because we were, quite frankly, had more trains than the railroad was designed for. So over these last couple of years, quite frankly, driven by the increase of shipping oil, we spent these billions of dollars and we added a second main line that will be there now forever. And you know, we've had this great debate right here in Montana about does oil hurt the ag shippers? And our position is that the investments now that are in the railroad, which will never go away, lifts all boats in terms of improving service for everybody. Yes?
You guys have been kind of at the forefront of developing natural gas as a motivation technology, but how does the diesel price change affected the viability of those developments?
Yeah, so the question is about LNG for locomotives, and we've had a long history of looking at different alternative fuels for locomotives. We actually had a hydrogen locomotive that we experimented with the Department of the Air Force, I think, or the Navy, and we actually had it out in California. It was kind of humorous. Governor Schwarzenegger came out to look at it and opened up the hood and said it looked just like his Hummer hydrogen engine. So we've been working on LNG now for a couple of years, and you know, when oil was in the $80 and natural gas was in the $3, it was a absolute no-brainer. Go as fast as you can, convert the whole fleet to LNG. When oil's at $40 and gas is at $2, it makes it a much harder decision. And so, you know, we're watching a lot of changes of the whole energy sector. We're watching, quite frankly, with carbon pricing. California already, we're now buying carbon credits to operate for transportation fuels in California. We're also buying them in British Columbia. We know that the state of Washington and the state of Oregon is also looking at either cap and trade or a carbon tax. So if the price of diesel or carbon is actually inflated through taxes, then it will make that spread look better. But what we've got to do is to find a little more certainty on where the spread relationship between oil and natural gas will end up settling out, and then we can make the investment decision. For us, total, it's probably a $7 to $8 billion decision, so it's not something that we want to make lightly. Anybody else? Yes. Yes. I have no idea. The question was how many rail cars are being idle between Colstrip and the city of Billings. I'll tell you, this is a number that's hard for anybody to get their head around. There's 1,700 miles of stored rail cars in the U.S. freight and rail network today. 1,700 miles. We've got, at our company alone, we've got 1,500 locomotives that are stored at about $2 million a copy. So there's enormous capacity. I mean, that's the good news is that you know, when the economy, and again, we have to separate out the consumer economy that's actually doing okay, and the stuff we make. And you know, we were talking about Billings. I mean, when the shale play was really going, there had to be just, even as far away as we are to the, you know, the western part of the shale play in Montana, I would submit that Billings had an overall boost in terms of economic development. I mean, this thing just spreads around, and the energy revolution was really, I think, providing that next layer of jobs, and we were seeing a little inflation, and you know, people were buying a lot more stuff, and we were riding in today, and Matt was telling me that you could hardly buy a pickup truck in the city of Billings back when things were really, you know, moving along. And so, you know, without that, and again, these commodity markets will move around, we're really going to have to rely on the consumer to keep this economy strong, because it's when you look at the big picture numbers, of GDP, they're just really not encouraging. And so that's why we have all these stored cars. We probably have them in some places that communities don't want them, but we don't have a lot of choices on where to put them, put that many cars. Anybody else? Yes? So the question is, how's the industry responding to threats of terrorism? Back on 9/11, we actually, right after 9/11, we actually got together with the FBI. Homeland Security wasn't developed then. And since then, we've actually got an office in Homeland Security. And we have a risk level, just like Homeland Security has for airports and, and all these cities. And ours is based on a little different issues. But we've had, since 9/11, we've had 3 times where we've shut down sections of the railroad network because of threats and communications that we thought were heading towards something. So, our big issues, our big concerns running a railroad are critical infrastructure, big bridges, tunnels, anhydrous, chlorine, those types of things. And so we use fact-based information that makes our threat level goes up and down. And then when we do get into a higher threat level, we actually handle certain commodities on the railroads differently. We don't operate certain things that we think have higher risk exposure. But fortunately, so far we've had no real issues. I actually worked on a commission with the CIA, advising them on just some things that were going on in corporate America, and in exchange, I got access to the information that they see in terms of their intelligence. And I was very interested in the rail side, there just really wasn't a lot of chatter around rail infrastructure. The terrorists, to this day, still seem to be focused on big, tall buildings and airplanes. Anybody else? Yes? How I see the election, how it comes out for the railroads. Whoa. This is being taped, right? Our country is at a real crossroads on the economy. And I would say for the last 7 years, we all know, coming out of 2000 and, depends on where you declare the recession started. We saw it in the fourth quarter of 2006, 2007, 2008 was our wallowing year, the really tough year. Ever since then, we basically have injected $4.5 trillion into the Federal Reserve, and we've gotten basically a 2% economy. And I think everybody in this room knows something's just wrong. And the country is not yet to the point where everybody is truly focused on how we make this economy grow. And that's why I use the example of what's going on up in Canada. Canada, the new prime minister is going to find out real quickly, they really live and die on their vast minerals and their vast commodities. I mean, it's incredible what they have. And what we saw in that Canadian gateway was everybody really getting focused. What do we have to do for infrastructure? What do we have to do for trade? What do we have to do for port development? What do we have to do with labor, ILWU labor? And everybody got focused on this issue. We're not there in our country. I mean, we are still fighting amongst ourselves. And we're going to have to make some hard decisions in this next economy, the next administration, on things like, has the EPA gone too far? I mean, coal's a great example. So, big scope, at the all-time peak in our country, we mined, I got some coal miners here, I'm probably going to get called out. I think we mined about 1.1 billion tons of coal. I think this year we will be down starting somewhere around 650 to 700 million tons. Worldwide, we mine about 6.5 billion tons of coal, And our own government says that we're going to increase, worldwide coal is going to increase to 8.5 billion tons by the year 2025. So the rest of the world is going to mine more and more and burn more and more coal. So what I always tell our environmental community is, if you're really concerned about the environment, you should burn more coal and figure out how to burn it with the right controls on it. Instead, we're going to create a little island in this country where we're not going to burn coal. We're going to lose tens and tens of thousands of jobs in the mining community, tens of thousands of jobs in the railroad community, tens of thousands of port workers, and all that. For what? So we won't mine coal, and the rest of the world's going to mine coal? And those are the trade-offs that we're going to have to make as a society. And with that, I will definitely get myself in trouble if I keep talking. So I want to thank you all very much, and we love Montana. We appreciate everything you do.
I had to come up here and save Matt from some more questions here about presidential politics. I think most Americans agree to use a rail metaphor. We're on the wrong track, Matt, so I think we need to get back on the right track.